Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending March 3rd, 2017. Boy, we've just had an unbelievable run over the past 4 weeks, and the markets are definitely kicking off the month of March fairly strong. Now, we've had the past couple of days a little bit of a settling in, but I don't really see much to it right now. Let me clear up this screen here for you. What I've got on this screen is the S&P 500 E-mini futures. And you can see since the Trump election, as everybody knows, we've moved a dramatic amount. Okay. What you see on the screen here, I've got some Fibonacci extensions off key prior pivot highs and lows, and these serve as a little bit of a potential support or resistance point as we move our way up. And once we broke the 2300 area, which is at a 1.5 extension off prior pivot high, then and a prior pivot low, we exploded up again. Now we consolidated for a bit of time right here, almost for a couple of months, really, from going into the second week in December all the way into the first week in February. And then from this point right there, the Trump administration came out and talked for the first time about a very strong tax incentive plan for corporate and for folks here in the U.S., and the markets just hadn't looked back since. Now, everything needs a rest. Everything is going to pull back in its own time. But I've been telling our members we're a buy on the dip type of environment right now. You can see there is absolutely what I call here a bed. There's a zero bed, which means basically zero bearish divergence. In fact, going all the way back, you can see it's pretty much all of these big moves here. This one off the Brexit low, or the Brexit bounce, and this is the Trump bounce. And then just very strong move here, and then a very strong move here into this support zone. And I've got friends that have just, talking up short this market, and they've been crying all the way up. Hopefully they're able to participate in some longs, and at least play in the direction of the price. The price wants to go higher, and that's what we're seeing here. Now, like I say, you can see the upward vector of the 200 EMA, the 50 EMA, and then I've got a very shorter 12 and a 4, and every one of them are like this. So can it go on like this for another week or two? It could, but I suspect what we're going to do is we're going to get some settling in on price, much like we did before. So after this big up run here, then we settled into a price for a couple of months. And in fact, we broke out, we came back in and we tested that range again. Now we broke up here, and now we're kind of doing one of these things. So I suspect we'll settle in here leading up to the FOMC with Aunt B, that's AKA Janet Yellen, or perhaps I should say Janet Yellen, aka Aunt B. She's going to come out and give us her recipe for blueberry pie March 15th. If it's a very tart pie, no butter, no sugar, which I suspect she's going to do, the markets, clearly are around an 80% probability of a rate hike March 15th. That's what we're looking at. So the markets have got all this priced in, and yet it's still going higher. You can see the mood and the sentiment of the markets. In fact, the market environment has changed, because if you guys remember back during all of the mass stimulus, the Feds have been dovish. I mean, for the past 9 or 10 years, they've been very dovish. And in 2011, 12, and 13, before they ended their stimulus program, every FOMC, we could expect Yellen to belly up to the podium and say, hey, even though the markets are showing some kind of strength, we've got some existential risk over in the Asian markets or over in the European markets. So there's always some excuse. But this whole week, all the Fed governors have been coming out, especially the ones that can vote, and have been saying it's time we raise the rates. And then Yellen spoke today and said, the market should expect an increasing rate or an accelerating rate of interest rates. Yet the market today was fairly benign. Yesterday, even with a little bit of a pullback, the markets were fairly benign with the volatility coming in. So the markets are just not, they've already discounted this rate hike that Yellen will do. And there's, you know, the general rule of thumb is anytime the market's priced more than 55% of a rate hike, then Yellen has a green light to hike the rates, because the one thing they don't want to do is spook the market. Now that the market's expecting it, this is a good opportunity for a hike the rates. So like I said, it's 80%. It may even go up then. But we before March 15th, we had a lot of Fed governors speak this week. I would say at least 7 or 8 of them. Yellen capped it off with the last one on Friday. I think all of this was timed and planned to let the markets know that's what they're planning on doing. They all did it this week because starting tomorrow, Saturday, March 4th, the Feds go into a quiet period where they cannot get in front of the press and talk. They've got to do that up until March 15th. And these folks, they love, these muckety mucks love to get in front of the press and talk and tell everybody, you know, what they want to do with the markets and so forth. So this is where we're sitting right now. I do believe that, as I said in last weekend's update, really not much has changed. I would expect a little bit of a pullback. In fact, for me, I could see a pullback coming down to this area very easily, 2341, but my favorite pullback area right now is right in this area here, right around 2300, okay? We're in a buy in a dip mode, so that to me means that anytime we come down here, you're going to see buyers willing to step in and say, okay, I'm going long. That's the mode we're in. And you can also see the 50 EMA is now moving into this area here. So it provides really good support. You can see on the left-hand side of the screen, volume over price. There's a lot of volume sitting right at that 38% fib extension at 2263. So we've got a lot of support right here. I do not see anything changing the dynamics of the market at this time. The only thing that I see on the near-term horizon, we've got some votes coming up in Europe, starting off with the Netherlands populist movement. Then we have France, Italy, and then Germany in the fall time, going into the fall. And we also have over here in the U.S., if the Congress and the Senate slow walks some of these potential tax cuts, or they get bogged down. Remember, a big part of this move right here is based on the anticipation of less regulation, tax cuts, repatriation of money from U.S. corporations back over in the U.S. But, you know, keep in mind that a good part of this is also companies reporting good earnings. They're finally out of the earnings recession mode and they're growing, and most of the forward guidance from the CEOs and CFOs talks about more capital spending. Now, a lot of them are waiting and sitting to get more money from Europe over here at a reduced tax rate via that repatriation that Trump wants to do. And they're also waiting on incentives for investing money here. But I believe, assuming Trump gets what he wants, this is what we're going to see. I do believe that we can have another 6 to 7% up move before the end of the year. Which would put the S&P right up around this area right here. We're sitting, believe it or not, right around just slightly under 2,400. We hit the all-time highs in the E-minis at 2,401. I could see us coming up somewhere in this range right here, anywhere from 2,450 up to 2,570, somewhere in that area there. That would give us a 2.3 fib extension off prior pivot high. Just an amazing run. Now, we would not get there with a straight shot. There's going to be a lot of bumps and grinds along the way. But this is if the sun and the moon and the stars line up and Trump gets what he wants. We're going to end up in this area here because there's just a pent-up demand for money going into the markets, because we've been relatively just benign. The only thing that's been moving the markets up, quite frankly, are interest rates being zero. So that is what I'm seeing. If I put all of my indicators back on the screen, you can see kind of where everything is and how I've got everything mapped out. But this is kind of what we're looking at right now on the S&P 500 futures. Now, the other thing that I find totally fascinating, with all of the talk that Yellen has and all the other governors about interest rates, you would think that the bond market would be even lower than what it did. The bond market actually moved up today, 13 ticks. If we look at bonds, you can see we're sitting right here. We actually made new 2017 lows, all right? So you can see that we've made new lows in the bond market at 148.23 or 148.22 rather, right there. We made new lows today, but then bonds moved back up for 2017, not new lows, but just for 2017. Remember, I had called for a low around 145 area right here. Now I've had this here going all the way back to January of this year, even when bonds were moving up. And we're still kind of in this range, but we're in this box. Bonds were up today, but that's just a little bit of a counter tick move, really. I think we're going to find ourselves somewhere down in this area. If they hike the rates and they come out a little bit more aggressive. Now remember, the Feds have said 3 rate hikes for the year. The markets have only priced in 2. But we could see bonds with a rate hike coming down here, but a lot of this move here is based on a potential rate hike coming. So a lot of it, in many respects, has been priced into the market. It's kind of like you've heard the old saying, buy or sell the rumor, buy on the rumor and sell on the fact, that kind of thing. You know, so that's kind of what we're seeing here in this situation. So bonds are just, it's amazing though how you would think they would be a lot lower than this, but they're not. I think we're going to settle in. I don't think it's going to go too high because I am still, and I'm on record, and I'm still predicting that we're going to have a 25 to 40% pullback sometime by 2018, not January of 2018, but sometime within the next, let's call it 6 months to a year and a half, something like that. That's kind of what I'm seeing right now. And if we look at currencies, here's the other interesting thing. Look at what the dollar did today. The dollar really came back down. If I put it on a 15-minute chart, you can see the dollar just rolled over. I mean, the dollar started rolling over back on March 2nd, and it's just hadn't looked back. And then look at what it did today. I mean, it was down almost 1%, and it just took out this prior pivot low right here, and it just kept right on going. There is no bullish divergence here at all. That would suggest any bounce is going to be sold. And by the same token, the euro did just the opposite. Look at the euro. And you would think with talk of more spending, I mean, more higher interest rates in the U.S., this would be doing just the opposite. This is why you can't go on what your logic sometimes tells you. You've got to let the price action tell you what the markets want to do. So looking at the euro, you can see we were in this up move, and then we had this counter trend here. I do believe the euro is going to come back in and take out the 2016 low, which was made towards the end of the year, and is going to make new 2017 lows. I had forecasted the euro to come down here around 102, somewhere in this area here. But there are a number of things that could drive the euro lower. We got a lot of political risk over in Europe now with these populist elections coming up, and it's going to tend to drive the dollar up because the euro is about 55 to 58% of the US dollar index. The pound was the other one that took off today too. I mean, it just, if you look at it on this daily chart, well, that is another one we'll talk about in just 1 minute. But if you look at the British pound, you can see here we're still in this tight box. I'm not going to get excited until the pound starts moving a little bit higher. But on the 15-minute chart, you can see for today, really going back when the euro started going higher and the dollar started going higher or lower, the pound and the euro were going up in tandem. Just moving up very strong. And if we look at the Mexican peso, look at this thing on the 15-minute chart. Bam, off it went, right? And we're going to probably settle in here a little bit and then probably move higher. And you would think with the administration, the Trump administration talking about a stronger dollar, border controls, and all those things like this, the peso would be going the other way. If we put it on the weekly chart, now it is down, right? That was a 15-minute chart. So you can see the peso has just been decimated starting in 2013. Actually, it really started back in 2011, and it's just been getting worse and worse since. We're trying to get a little bit of a bounce here. I still believe it's more of a dead cat bounce. We could probably run up a little bit, but I would not be a bull in the Mexican peso. I would probably look at maybe a counter trend rally up, but I wouldn't be a bull. Gold also was up a little bit today. Most of that was driven by the weak dollar. You can see this expanding channel as we move up. Let me put it on the daily chart. It'll show up a little bit better for you. You can see this expanding channel here. We broke the 200 EMA today, but the 50 it held up. If the 50 can hold, that'll be a very important for me. You know, what's gold going to do? Now, gold hates higher interest rates. It likes higher inflation, and it likes risk. When there's a risk off in the market, meaning there's too much risk, gold likes those environments. But higher interest rates, it hates. It competes with dividend-paying stocks, and dividend-paying stocks also compete with bonds. But you start tacking on a lot of higher interest rates, and money can come out of gold pretty quickly. So I have said, and I still believe gold is due for a nice little run here. And we've had one really going back to the first week in December, or the middle of December. We've had a good run up from 1130. We're sitting at about 1226 now, so about a 100-point run. I think a little bit of a pullback is only going to be natural. But I'm looking for it to hold at the 50 EMA or the 1200 level, this shaded zone. That's a key psychological barrier. If that gives that up, watch out. Silver, same thing. Silver's been in this tight regression channel, as you can see, to the upside. It's a little bit better than gold. It's above the 50 EMA. We've had the 50 and the 200 EMA cross, and those of you that have worked with me a long time know that when that cross happens, it also serves as a natural boundary and like a bug zapper to come in, grab it, and then move back higher again. You can see this 3-leg. That would probably give us a 4-leg Elliott wave print, and then a 5-leg somewhere up there. So I don't know if this is going to come true, but you can see the 50 and the 200 EMA. Usually when they cross, it serves as, like here it crossed right there, and then you can see we came right up and we tested and spent almost half a month there before we came back up. So now if this thing comes back down, we'll probably test that second cross right in that area again. And then I'm looking for this to hold, and then for silver to move up. Okay. And then of course, if we look at oil, we're in a trade now that's profitable for us in oil. We went into another one last week. Oil has done nothing but just go range bound. That's all it's done. Okay, I mean, we're just stuck here, and we're playing that accordingly. For those of you that are watching these videos, these weekend videos that I put out for our user group, you may want to consider coming on in and taking a look at us as a Secret Trader member. We're doing real well there. And it's a follow me service where you can follow what I'm doing, but also participate in our chat room and look at from an educational standpoint, learn how to do some of the things that we're doing. But you can see here, we've got profits in the oil trade. I suspect we bounced really nicely. I mean, it was a hard bounce too. You can see where we bounced off the 50 EMA, and now we're doing it again right there, right? So if that breaks, and we'll come down and test the 2017 lows, and wouldn't quite frankly, it wouldn't surprise me. That pattern in the MACD is a consolidation pattern, but you know, your eyeball is just eyeballing, and they'll tell you that's what it's doing, right? So that's where we are in oil, and we're not doing anything in gasoline. Ag, we've been in and out of ag several times over the past couple of I'd say over the past 4 months. Profitable trades. We just got out of a corn trade. I'm not doing anything in ags right now. And then of course in the softs, orange juice and sugar we're playing. Cocoa has just had one of those decimated moves right here. In fact, we made a new low just the other day in cocoa, and I still believe it can go even lower. This shaded zone represents a long-term major support point, and just to show you, I got to go all the way back to right in this area here, going back to 2011. This is a daily chart, but you can see where it's a solid support area, and then we just took it out right here. You can see some bullish divergence starting to build up here, so I think, you know, this thing needs to work itself out with cocoa. I've heard a lot of people talking about going long cocoa, but if you look at the way cocoa handled down this area before, it had a lot of false moves. And then even one here where it looked like it broke out and then it came back, came down again, and then away it went, right? So these are tradable events right here, but very short term. And then if you break over a certain key level, then you can just add to it. But even if you stay in it on a nice ride up, it's very volatile. Cocoa is just gonna, if you don't have a large account, it's gonna whipsaw you around a little bit, because as you can see, it's not a very smooth move up, although this move down has been very, very tight and just a lot of selling there. So that's cocoa. It's going to be ready for us to trade. I was telling our members, probably be ready sometime in the next 3 to 9 months. We'll probably get something here, almost like waiting for a baby to be born. 9 months, take the trigger. But that's where we're looking at for cocoa. All right, everybody, that's pretty much my update for this weekend. If you're not a member of our group, I highly encourage you to come in and check us out. I've got a couple of offers that you probably saw that are up beneath this video or in the email that you got. So come on and check us out. Otherwise, for our members, I'll see you Sunday night. We got our weekly market watch. We'll go over what we're seeing, what I'm seeing coming up for the next week. These next 2 weeks, I think, again, just to reiterate, we'll probably be in a sideways pattern. We may even pull back just a little bit. We're still a buy on the dip kind of mode. Just looking at the E-minis, again, we were only down, 1.5 points, not even a 0.06% move to the downside. So we're going to probably stay in a fairly tight range until we get through Yellen. And then let's see how this thing goes. All right, everybody, have a great weekend. Members, I'll see you Sunday night. Bye now.